Welcome to CoreLogic's update on housing market conditions for March 2022. CoreLogic's National Home Value Index posted a 0.6% gain last month, taking Australia's housing market into the 17th consecutive month of increasing values. While housing prices are still generally rising, the pace of growth in the national index has been easing since April of last year. February's growth rate of 0.6% marked the lowest monthly growth reading since October of 2020 and is down from 1.1% in January and down from a cyclical peak of 2.8% in March of 2021. Every capital city and broad rest of state region is now recording a slowing trend in value growth, albeit with significant diversity. Sydney and Melbourne have shown the sharpest slowdown, with Sydney posting the first decline in housing values since September of 2020, while Melbourne housing values were unchanged over the month, following a similar and relatively flat outcome in December and in January. Conditions are easing less noticeably across the smaller capitals, especially in Brisbane, Adelaide and Hobart, where housing values rose by more than 1% in February. Similarly, regional markets have been somewhat insulated to slowing growth conditions, with 5 of the 6 rest of state regions continuing to record monthly gains in excess of 1.2%. Over the past 3 months, housing values across the combined rest of state regions increased at more than 3 times the speed of housing values across the combined capital cities, at 5.7% and 1.8% respectively. Regional housing markets aren't likely to be immune from the higher cost of debt as fixed-term mortgage rates rise. These markets are also increasingly impacted by worsening affordability constraints as housing prices consistently and substantially outpace incomes. However, demographic tailwinds, low inventory levels, and ongoing demand for coastal or tree change housing options is keeping upwards pressure on housing prices. Advertised inventory levels help to explain some of the divergence in housing growth trends. In Melbourne, advertised stock levels are now above average, tracking 5.5% higher than a year ago and 4.7% above the previous 5-year average. The trend is similar, but not quite as advanced in Sydney, with total advertised stock levels 6.3% higher than last year, but still 4.7% below the previous 5-year average. More choice translates to less urgency for buyers and some empowerment at the negotiation table. The cities where housing values are rising more rapidly continue to show a clear lack of available properties to purchase. Total listings across Brisbane and Adelaide remain more than 20% lower than a year ago and more than 40% below the previous 5-year average. Similarly, advertised supply across the combined rest of state markets was nearly 25% below last year and almost 45% below the 5-year average. Perth home values have gathered some momentum over recent months, albeit off a low base. The monthly rate of growth was easing through most of last year, culminating in a 0.1% monthly decline last October. Since that time, the trend rate of growth has picked up to reach a rolling 3-month increase of 1.3%, the highest quarterly trend since July last year. With state borders now open, we could see some upside for Perth housing demand. House values are the lowest of any capital city, rental markets are relatively tight, listings remain below average, and the economy is strong. With these fundamentals, the Perth housing market should be recording a higher rate of growth. Since the onset of the pandemic in March 2020, Australian housing values have risen by 24.6%, adding roughly $144,000 to the value of an Australian dwelling. Such a high rate of capital gain in a period of low income growth can be explained by many factors, including record low interest rates, improved affordability following the 2017 to 2019 reduction in housing values, higher levels of housing sentiment, a surge in household savings amid lockdowns, and an imbalance between demand and supply. Fiscal policies have supported or incentivized housing activity as well. But each of these factors are losing their potency to drive housing values higher. Fixed-term mortgage rates have been trending higher since early 2021, with the upwards trend sharpening through the December quarter last year. Variable mortgage rates are set to rise in line with the cash rate, probably later this year, which is likely to weigh on borrowing decisions. While mortgage rates are expected to remain well below average levels for an extended period of time, households are likely to be more sensitive to a higher cost of debt, considering housing debt ratios are at record levels. Housing affordability has been eroded by the high rate of growth in dwelling values alongside low income growth. Between March of 2020 and December 2021, wages increased by 3.3% compared to a 22.6% lift in housing values. Not only does worsening affordability restrict access to the housing market, especially for first home buyers, it also erodes housing sentiment. Measures of housing sentiment have been reducing since November of 2020, reflecting a mix of affordability challenges and rising mortgage rates. More broadly, consumer sentiment could be further negatively impacted by Russia's invasion of Ukraine, triggering a new wave of global uncertainty. Consumer sentiment and housing market activity have historically shown a strong correlation. So if sentiment does trend lower, we could see that denting housing demand further. The balance of housing supply and demand is also normalising. This trend is most advanced in Melbourne, where total listings are now above average, but also in Sydney, where listings are approaching average levels. Additionally, the rollout of vaccinations and a significant easing in social distancing restrictions is seeing increased foot traffic in cities like Sydney and Melbourne. As Australians cautiously emerge from social distancing, there is likely to be a shift in household spending and a slowdown in savings that may have previously supported or gone towards a deposit on a home. While the downside risks to housing are growing, there are some upsides that should help to insulate the market from a sudden downturn. Open borders, both domestically and internationally, should support housing demand. While a return of overseas travel isn't expected to boost home buying demand immediately, we are expecting stronger rental demand in key areas such as inner city precincts, popular with foreign visitors and students. A lift in long-term or permanent migration should provide a gradual boost to purchasing demand over time. Improving economic conditions and higher wages growth should also help to keep a floor under housing demand and keep distressed property sales to a minimum. Hopes that 2022 would deliver more certainty and less disruption are looking far-fetched at the moment, with the east coast of Australia encountering record levels of rainfall and extreme flooding, the invasion of Ukraine stoking global uncertainty, and prospects for higher inflation and wages growth potentially forcing interest rates higher. Of course, we'll be doing our best to measure the effect of all these factors on housing market dynamics. You can stay tuned to our research updates at CoreLogic.com.au.